Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
It's always a pleasure, my old friend. Nice to see you. You're looking dapper today, very sharp.
Oh, well, thank you so much. And it's great to see you. But the first topic I'd like to discuss is how it seems like there's a lot of silver short covering happening right now. And it seems like people are also mentioning how looking at the COT report, there's a lot of big money stepping in, purchasing gold and silver. Your perspective on what you're seeing?
Well, I've been following the commitment of traders reports for about as long as I've been running TF Metals Report, which is a dozen years now. And I mean, the first thing people need to know is they're not a trading device because the information is surveyed every Tuesday at the COMEX close. Some of the banks and other market participants in the past have been fined for submitting false information. So you got to take that into account. But if anything, the information that they do get is then it takes them 74 hours to process it and make it public. So all you can really use the COT, the commitment of traders reports for is kind of, you have to have a historical basis. When you look at them, you got to go back and remember times when, the structure of the large speculators or the hedge funds and, versus the commercials and the banks, times in the past when the structure has been the same, and then compare that to where price is versus where the price was back then and try to draw some comparisons. And that's really the value of it. In kind of the bigger picture, you can look at it as and say, well, okay, when there's speculative excess and price is getting ready to fall, it means that the speculators and the hedge funds are all long, and that all the entities that usually trade on the long side have gotten long. And at that point, you have potential for more sellers and buyers. And all that needs to happen is for price to tip over. And then things starts to, kind of cascade itself down and you start getting some stops and, that sort of thing. And we recognize that. And we've seen that obviously for longer than I can remember. The opposite is also true, but people don't necessarily want to believe it, that at bottoms, those same speculators and hedge funds get short. And after a while, all that are going to get short have gotten short, which then leads you to have more buyers than sellers eventually. And price starts to go up and shorts get squeezed and covered and price goes up some more. And that's exactly what we saw over the last 3-4 weeks, I guess. Silver dropped down to $18 one day, intraday. We saw that the hedge fund category within those reports showed a position of something like 18,000 contracts net short, which for context, I mean, we've seen that as many as 60 or 80,000 contracts net long before. So when you get that short, which means then the issuing banks are long, you feel like you're pretty close to a bottom. And what happened is you got this surge off of that $18 level. Price rallied, 15% in 2 weeks. The follow-up reports detailed that it really was just these hedge funds that were covering those shorts. And when you cover a short position, you have to buy it back. You're buying, and that's what makes price go up. So that's what happened. And now we're kind of in this kind of no man's land, kind of limbo area where maybe they'll come in and short some more. Maybe price will go higher and cause more short covering. That's typically how rallies begin. You start by getting short covering and flipping those positions, but we haven't quite crossed that bridge just yet. So we're kind of stuck here around $20.
It does seem like we're kind of stuck here. As you mentioned, people have been hopeful that, we have made that low of around 1850 and we're heading higher from here. And what we're seeing in the last couple of days is just a bit of a pullback, and we should be reversing from here. Do you see us moving sideways for the rest of the summer, or do you see us actually breaking out above this level that we've been in for a while?
Well, this has been pretty aggravating for me and people at my site because we saw this move coming out of late last year into the first part of this year. And I wrote about it in my little annual forecast I write every January, and that, the Fed was going to go through these shenanigans and job owning to get interest rates higher to try to control inflation. And that would probably prompt a drop, to 1,800 in gold and below $20 in silver. And I thought, well, that would probably be the lows. And I thought that would happen maybe by May, June. And here we are now in August, and we're still at these levels. And that's the hard part, is where this is headed. I mean, eventually the Fed's got to start cutting again, and interest rates are going to go back down. It's the same games that they've been playing now since 2009. Problem is, it doesn't move at my pace, my preferred pace. I thought maybe the stock market would crash and that would prompt the Fed to pivot. Well, the stock market crashed, but it really didn't cause that pivot. And so things are just kind of moving along at a slower pace than I'd hoped. So eventually, yeah, the Fed will pivot and they'll start cutting again, and they'll have to do QE to monetize, all new debt and refunding that's coming. But until that actually happens, we're kind of go sideways. The period is analogous to late 2018 and the first half of 19, Elijah, where the Fed had spent about 4 years trying to jawbone quantitative tightening and interest rates. They got the 10-year up to 3.25, and then the stock market collapsed. You got the Powell pivot in late December of 18, but the Fed didn't actually start cutting rates until June of 19. So in that period of 6 months, gold went up, and then it kind of grinded backwards. And then once the Fed started cutting in June of 19, it shot higher, about 25% in 90 days. That's kind of where we are again now. I think Powell, regardless of what anybody says, pivoted with his language at the last FOMC meeting 3 weeks ago, when he said, we have moved in the past tense to a neutral rate. We have moved. That's what he said. So now we just wait, the 4, 5, 6 months, whatever it takes, until the Fed actually pivots with policy. And so that's why we might continue to kind of just slowly grind higher for the next, several weeks or a couple of months.
I would like to get back to what we were talking about at the top of the interview, the COT report, and it seems like there's a lot of silver, a short covering right now. Could you expand on what is motivating a lot of the big players to do this right now?
It's just a financial pain, right? If you're short, 100 silver contracts at a price of $19, and you put those on back in early July, thinking it was going to go to 16 or whatever, and all of a sudden the price goes to 20, when you're underwater, what, $5,000 on 100 contracts, that's $500,000. I can even do that math on the fly. And eventually you're starting to get margin calls, and you're like, oh man, I can't lose any more in this position. And so you cover it. And so the higher price goes, the more of those existing shorts are now underwater, and it increases the pressure on those hedge funds to either put up more money as a margin call or just cover them, just get out, just lick your wounds and move on. And that's generally where you get it. And it's just the opposite of when price comes down. You're piling in the longs because you're all excited because price is going to go higher. Price starts to break down. You put some stops under say it breaks below the 50-day moving average. Maybe you're going to put a stop below there, some other technical level, and the stop gets hit and price falls farther. And the same thing happens in a short squeeze, the upside, which is how we got 15% in 2 weeks. The key level now is pretty clear on the chart. The 50-day moving average is something that the front month September has fallen back below just this week. But also there's, that level up around where we're banging up against it last week, around 2075 to 2080. If you can bounce and get back above the 50-day, probably maybe on dollar weakness later this week or next, and then you can start maybe making a higher high above 21. Because now think of it this way, Elijah, if you're a trader and you're short, or you're a hedge fund, you're short, and you're kind of, okay, maybe we're safe. Silver came back down 3% yesterday. Okay, where am I going to put a stop on this position, a buy stop, if price accelerates again? Well, you're going to look at the chart. And you're going to go, well, let's see. Last week it got up to 2080. Let's put in a buy stop at 21. If it breaks above 21, then we'll buy and we'll cover and get out of this, because it probably means it's going to 22. Well, then that's what we'll wait for next on the upside, is we'll think, okay, if price can get above 21, then you'll probably get like an air pocket where price goes from 21 to 21.25 in like 5 minutes. And so that's how that process works. So now we need to, if you want to rally and see some gains in the short term, then you need to get back above the 50-day and make a higher high than where we were Friday's close, to prompt more of this short cover.
Now, moving to what the Fed is doing right now, we do see there is going to be the Jackson Hole meeting very soon. Your
Yeah.
perspective on how that, what is going to be discussed there and how that might move the markets.
Well, this meeting, the Jerry Powell will be out there and they'll fly in Countess Lagarde and, the other central bankers from around the world. They all sit in Jackson Hole and they've all watched Yellowstone probably on TV. So they all think they're cowboys when they get out there. But it's kind of Powell will give, and any Fed head when they do this, is almost like the State of the Union for the president. It's like their one really big policy speech. For example, 2 years ago was the one where Powell went out there all worried about deflation. And he announced a policy change, which had been kind of trial ballooned a month before by the Wall Street Journal and Bloomberg, that they said they're going to start averaging inflation. They're not just going to have a 2% monthly target. It's got to average 2%. Remember these days? This seems like forever ago when they're only trying to get inflation at 2%. Anyway, it was that policy change that was announced at Jackson Hole 2 years ago. That's what you'll watch to see whatever Powell says 10 days from now. I think it's next Friday, the 20, what will that be? The 25th, 26th. That's what you'll wait to see if he's got any, if he'll expand further on this. We have moved to the neutral rate, or we are now going to be more data dependent. The other thing that he said 3 weeks ago. We'll see. But that'll be, and in the month of August, there's really not much else going on. All the European traders are down there on the Côte d'Azur, living the high life on the south of France. A lot of the American traders are out in the Hamptons doing their thing, sitting by the pool and going to the beach. And so you're subject during this month to mainly just computer trading. The HFT pre-programmed algos that are buying and selling the futures contracts based off of the moves in the dollar and the bond market. And so you get lower volume, lower liquidity, and you're subject to sharper moves like what we got yesterday, where the dollar rallied and silver in all commodities all just plunged. It wouldn't have been as bad, on a day like that in, say, October when there are actual human beings monitoring things. And we could easily just turn around the same thing. Dollar falls back after Jackson Hole or whatever, and silver and gold could just rocket right back up too and regain all those losses from earlier this week. So it's a quiet month, but that Jackson Hole speech next week will be the big event before we get into Labor Day and the next jobs report and everything else.
It does seem like we're seeing, it's possible that we could be seeing like a not cooling off, but topping of inflation, right? Where we're starting then to see disinflation, because we did see the recent inflation number at 8.5% rather than the month before at 9.1%. Do you think that is going to impact the Fed's decision at all?
Well, I don't know. They're going to have to eventually pick one or the other. I mean, they could keep hiking away, and drive mortgage rates to 8% and all that kind of stuff, and further kill the economy. They've already inverted the yield curve by 30 or 40 basis points. We're already clearly in a recession, unless you want to change the definition of recession, like the political economists are trying to do. So they can do that and pushes U.S. into a deep recession, or they can ease off and try to keep the markets afloat and the economy afloat too. I think that's the direction they'll go, but what do I know? I'm just this dope out here in the middle of nowhere that watches this stuff. I don't know, Elijah. It'll be interesting to see where the inflation numbers go from here. The drop, or again, inflation is still 8.5%, higher than last year. The ease in the advancement of it was predictable just because crude oil had gone down from 125 to 95, and that's the biggest driver of everything is energy prices, and gasoline had fallen from $5 to $4. And so that was predictable. But now you look and it's like, well, okay, we're heading into the wintertime. U.S. natural gas prices are the highest they've been since 2008. Natural gas prices in Europe are just outrageous. I just read something this morning about how the cotton crop has been essentially destroyed by the heat and the drought in the southern plains this year. And so copper prices are soaring, or cotton prices are soaring, I should say. So we don't use cotton for anything, so don't worry about that. So I think it's kind of, I don't want to say naive, silly, maybe not fully thought out, this idea that suddenly we're going to go into deflation when there are still so many input costs that are soaring, and we still have all these dollars that are out there, that, whatever it is, 4 or 5 trillion in dollars that were created a couple of years ago. They're out there sloshing around, chasing too few goods. So inflation may ease back before going up again. I don't think there's any way the Fed will ever get the Fed funds rate up above the inflation rate. That I don't think they can ever get it that far before they have to pivot and reverse.
And it does seem like as long as that real inflation rate then does stay above or does stay negative, then that should be bullish for gold. It just seems kind of interesting how over the last 2 years, gold has pretty much gone sideways and silver down.
Well, and again, this just gets back to how it's priced, Elijah, and who trades all these derivative contracts that set the price. I mean, I just mentioned, it's almost all markets are run by computers now, not just the futures markets. I mean, the stock market is 80% HFT computer. That's how you're able to get, however many billions of shares are traded every day, because these HFTs trade stock positions back and forth, trying to nick each other for fractions of a penny. Well, the same thing is true in the futures markets. You got these machines that are pre-programmed to either buy or sell gold futures or silver futures based off primarily movements in the dollar intraday and movements in the bond market intraday. Well, they're also watching real interest rates. And here's the fallacy of that. I mean, real interest rates are the 95% correlated to gold prices, not just inflation, but inflation adjusted interest rates. Well, problem with that is you and I, thinking rational human beings, we would sit back and equate or come up with a real interest rate using today's numbers. We'd go, okay, 10-year treasury, let's say, is 3%. Current CPI is 8.5%. And we go, okay, well, at least at the time of me purchasing this 10-year treasury note, I'm locking in a 5.5% loss of purchasing power this first year. And then I got to look forward to decide if this is a smart idea. And okay, well, what's my real rate going to be next year? Maybe -3, as inflation comes down a little. How positive do real rates have to get over the life of that 10-year investment to actually get it back to zero? I mean, I'm going to have some pretty positive real rates in years 7, 8, 9, and 10 to get back to where at least I broke even, right? That's how you and I would look at it. But the machines don't have time to do that. They just look at the 10-year inflation expectations as of this moment, which is like, God, they can't even tell you what the weather's going to be a week from now. Every economists are notoriously incorrect with not only their economic forecast, but their inflation rate forecast. Look at the Fed inflation rate forecast for the last 10 years. They're horrible. But yet we're supposed to believe, right, that the 10-year break evens, as they call it, because believe it or not, there are markets that trade on inflation expectations. We're supposed to believe that that inflation expectation 10 years out is accurate. And so these computers are programmed to buy and sell futures contracts based on the difference between the current nominal rate of the 10-year note and the current 10-year inflation expectation, which is like 2.6% on some of these measures. So they actually, computers look at it as saying it's a plus 0.2. When you and I look at it in real time and go, no, it's negative 5.5. But it's that fallacy. It's a part of how the computers are programmed. It's also due to how we price these things, price gold, that creates this illusion that somehow gold is no longer an inflation hedge. I suspect it is, and that $1,800 gold is quite the bargain in the grand scheme of things. But everybody else just wants to look at it through this lens, this prism of how the markets trade, and write it off as being, gold doesn't work anymore. Well, we'll see. Give it time.
I think that's so interesting. What you mentioned is really, it's just computers looking at this and making that calculation. But at the end of the day, it's based on expectations that have been completely wrong over the last couple of years, as we've seen inflation skyrocket. So it seems like if inflation isn't going down, then there has to come a point where people realize, the majority of investors realize, then, wait a second, these models are wrong, and there will be a rush towards gold. Your perspective on that?
Or a rush toward higher inflation. That's the thing about the inflation numbers. You think of like the University of Michigan consumer sentiment numbers and inflation expectations come out once a month, or the New York Fed. These are just surveys. They call people and businesses, a handful of people, try to extrapolate it out into a bigger sample size, like a political poll, right? Well, how sophisticated are those folks? And a lot of them are just basing their inflation expectations off of their most recent fill up of their gas tank or what the current CPI is. So the longer that inflation, think of it this way, the longer inflation stays sticky, even at 3, 4, 5%, the longer that takes hold in inflation expectations, and inflation expectations start to rise. Even that phony baloney break-even stuff that I was talking about, that starts to get sticky and rise to 3, 4%. Now you combine that in the next year, 18 months of the Fed having to pivot toward cutting rates and restarting QE because the economy is, faltering. Now, all of a sudden, you get the 10-year note back to 2%, but these inflation expectations have stayed sticky at 4. Now that calculation the machines use is -2. I would tell you, just remind everybody that when that calculation got to slightly more than -1 in August of 2020, gold went to 2,100. When it got to about -0.9 in March of this year, gold went to 2,100. So even under this current pricing scheme and all the wrong fallacies and the joke of it that it is with the computers and everything else, even under this, we're heading to a structure most likely where real rates will be perceived as being -2%. That's double what they were perceived at the last time gold was north of 2,000. So I think you can kind of connect the dots to see where I think prices are headed in the intermediate time frame.
All right. And if people are interested in tracking all this with you, then they can go to tfmetalsreport.com. Tell us a little bit about that.
12 years now, Elijah. I was a young guy like you. Now look at me. I always gray. I look like I was trying to look like Alexander Hamilton with my long hair, and instead I ended up looking like Ben Franklin. But 12 years in the markets will do that to you, and especially these markets. But I think the site, not so much of what I do, my daily analysis and podcast, I think the site's invaluable for what it is. And it's a community of people globally that are all kind of looking out for each other, and recognizing that these are some crazy times, true fourth turning kind of stuff. And you need a place that you can go. I mean, if you don't have neighbors and friends and people that understand it the way you do, or they're looking out for you and providing information to help you prepare for where this is all headed, then my site can be that for you. It's $15 a month, so it's not free, but I think it's well worth that, the 50 cents a day, just to have that camaraderie and that community to help you see where this is going and prepare for all those, all these eventualities. So check us out, just tfmetalsreport.com. I think we don't have a lot of people leave. We have more people come than leave. And I think they stick around because they see the value in it. So anyway, thanks for just stop by. Check us out.
Link is in the description for that. And once again, Craig, thank you so much for your time and insights today.
It's always a pleasure, Elijah. We'll do this again soon, I hope.
Sounds good.